We have a brand new IPO on the public markets here, Dutch Bros. This is a popular coffee chain that offers a variety of traditional drinks as well as many unique drinks, which adds to their appeal from a consumer perspective. So far, since going public yesterday, investors have seen over 28% gain in the stock, which is an outstanding return, especially for just 2 days. Now, full disclosure right up front, I do not own any shares in Dutch Bros as of recording this video, but I do own shares in one of its largest competitors, Starbucks. Now, Starbucks has not been having a good week recently, and it's kind of correlated a little bit to this IPO from Dutch Bros, but they're also having some other internal issues. But regardless, the stock is not doing well right now. But anyways, the purpose of this video is talk about Dutch Bros, talk about, high level, what the value proposition really is here from an investor's perspective, why we may want to consider this or not want to consider this, and kind of look a little bit at its fundamentals to see if, compared to its peers, this is a reasonable valuation today. If we get a lot of interest in this video and you guys want to see a more in-depth video on this, I will then go ahead and make a more deeper dive video. But let's go through this one step at a time. Let's talk about Dutch Bros here from a higher level and see where that takes us. So guys, all I ask here is if you enjoyed this content, you appreciate the research that I did to bring you this video, take a second, hit the like button, helps the channel out tremendously, and I appreciate it. So real quick, as of June 30th, Dutch Bros is in operation for 30 years now, and they have over 470 stores across 11 states. They're slowly expanding from the west with no stores yet on the east coast as of today. So this tells me right off the bat that this company has a ton of potential to expand into the rest of the United States and also eventually possibly go worldwide. For reference, Starbucks has over 15,000 stores in the US, and of course they're pretty much in every single state. So this tells you the market here that Dutch Bros can capture and compete in is fairly large. So I don't really need to go too much further here into the business model of Dutch Bros. It's fairly simple company to understand here. But what I will do now, going through the rest of this video, is I'm going to draw comparisons to Starbucks, even McDonald's at some point, to help us understand if the valuation that we're seeing today from Dutch Bros actually makes sense. So let's kind of start off with market cap here. As of going public, Dutch Bros should have around 165.1 million shares, which gives it a valuation of $3.8 billion at $23 per share. But as of today, as you guys know, the stock is up quite massively from that. We're at around $44 per share. Who knows, with the volatility, it could be higher than that, lower than that by the time you watch this video. But all this means that the valuation is now shot up north of $7 billion. This means that the valuation today is pretty much double what the company intended to go public at. So good on them. Starbucks, for reference, is a $134 billion company. So even with this huge spike in value, Dutch Bros is still only a fraction of their competition. But let's be clear, let's not draw comparisons to Starbucks and say that this should be valued the same as Starbucks, because I don't think that it deserves anywhere near the valuation today. Because Starbucks has built their brand and reputation over many, many years. They've expanded across the country, across the world. They've dominated different markets in different countries around the world. And that's why investors give it such a premium valuation. They also have an outstanding management team, outstanding track record of running the business, and everything about Starbucks just screams value and screams high quality. So let's not jump the gun here and say, oh, well, Starbucks is valued at $100+ billion. So Dutch Bros should also be valued at that today, because while they are competing for the same market, they are very different businesses today. Now in 2020, Dutch Bros reported $244 million in revenue, and so far for the first half of 2021, they have pulled in $180 million in revenue. So, if we're conservative, we double this, we can expect, say, $360 million in revenue for this year. And using that gives us kind of a projected price to sales of around 820. Now, maybe that's high, maybe that's low. We don't really know where that sits. But what we can do is compare it to its peers, again, Starbucks and some other companies, to understand what the market generally values these companies at. Starbucks has a price to sales of around a 4.62 for this year. McDonald's, which isn't a direct competitor completely, but they also offer, drinks and all that kind of stuff, they have a forward price to sales of 7.7. QSR Restaurant Brands, which owns Tim Hortons and some other chains, they have the lowest price of sales here at around a 3.46. So while these aren't exact direct replica companies of Dutch Bros, they're all competing somewhat for a similar market, providing drinks to consumers, and some of these other ones provide other stuff too. But it's kind of clear this segment is valued around, a 3 to like a 8 price of sales. Let's just say somewhere in that range. Now we go back to Dutch Bros where they have a valuation price of sales of 20 today. Yeah, that looks pretty expensive. But maybe the market is pricing the stock for huge growth going forward. As we saw, they only have less than 500 stores right now. These other companies are massive, massive companies, so the potential for them to grow much bigger is much less. So, maybe there's a case to justify this higher valuation here for Dutch Bros. We'll have to wait and see if they can actually live up to that. But just remember that these sort of projections of, a high price of sales implying that it should be a more premium company, the company has a lot to live up to, and these changes don't really happen overnight. So because of this, I think the market's setting up very high expectations short term for Dutch Bros, which could be a negative for the stock because it could set it up for failure right now. Now next year I want to look at their balance sheet real quick, and I didn't like a few things that I saw. So firstly, cash balance has dropped significantly year over year, which implies that they needed capital ASAP, which may be a big reason why they chose to go public right now. And real quick, when a company goes public and I see their balance sheet kind of dwindling in cash, it kind of shows me that they're going public from a position of weakness. I personally like investing in companies that go through a position of strength. That's why I like direct listed companies, because they're listing their stock for investors like us to buy it, but they're not really going public for the sake of raising a huge amount of capital and all that kind of stuff. So that's personal preference. That's just something that I noticed. But anyways, back to the balance sheet. They did invest quite a bit into their properties, probably through expanding more locations. But another red flag here that I see is high goodwill as well on the balance sheet. I'm not a huge fan of this. All in all, total assets sits at $285 million currently. And looking at the liabilities, they have $87 million of current liabilities, which their current assets cannot cover. So this is a concern. And they also have $412 million of total liabilities, $191 million of that being long-term debt. So objectively speaking, this company is debt-ridden. Overall, liabilities are greater than assets, so that's a big negative here for me personally. Now, I do understand that they went public, so they raised money from that, so the balance sheet is going to change. So I'm going to kind of, have this in the back burner, just keep this in mind, wait for their next earnings report to see what the new updated financials look like, and then at that point, reassess this balance sheet, because as of looking at this, I'm not too impressed right now. Now, one positive is that they are a profitable business, but it only grew profitability very slightly year over year, even though their revenue grew substantially year over year. And this implies to me that their operating costs are actually quite high, which hurts their margins. Now guys, like I said, I do own Starbucks. I also do own McDonald's. I really do like this space of kind of fast food, chains expanding around the country, expanding around the world with a strong brand. And I think Dutch Bros has the potential to build that, especially here in the United States. However, paying a premium valuation for a company like this just doesn't make sense to me. I think they have a lot to prove. I think they have fierce competition from these massive giants. And because of that, I would want to see this company at a much, much lower valuation for me personally to invest in it. That does not mean that the stock price can't go much higher, because in the short term, these things are driven by emotions, by FOMO, by investors just, they want to get in because they love the brand. But eventually over time, the fundamentals will matter. That's when the stock price could see some sharp selling. And that's where I may consider buying into this stock at that point. Again, the balance sheet was a big concern for me, but I'll wait for their updated financials to see how much they raised from the IPO, what they use that cash towards, if they pay down some of that debt, all that kind of stuff. I think the next earnings will make things a lot more clear. But for now, it's kind of the Wild West. The stock is super volatile. You can make a lot of money in it. But just remember that speculation and it's short-term trading, which could work out, but could also burn you. So just be careful. So whether you agree or disagree with me, I'd love to hear your thoughts in the comments down below. Let me know if you believe that Dutch Bros is the next Starbucks, whether they deserve the valuation they're at today because, they're going to grow much bigger, or whether you think that based on what they're doing today, The company is too expensive already here on the public markets. As always, guys, love to hear your thoughts in the comments down below. But either way, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.